Lehman Brothers did not fail because housing prices fell. It failed because its balance sheet was built for a world that no longer existed. For years, leverage magnified returns. Short-term funding financed long-term mortgage assets. Confidence substituted for capital. When housing prices stalled, asset values weakened. When asset values weakened, lenders demanded more collateral. When collateral demands increased, liquidity evaporated. In September 2008, Lehman could no longer refinance itself. It was not the first firm exposed to subprime risk. It was the first major institution that markets decided not to save. On September 15, 2008, Lehman Brothers filed for bankruptcy, the largest bankruptcy in American history. The collapse was not sudden. It was structural leverage meeting a stress it could not survive. Lehman Brothers was founded in 1850. It evolved from a commodities brokerage into a global investment bank. By the early 2000s, it operated at the center of Wall Street. Its core business was capital markets intermediation. It underwrote securities. It structured complex financial products. It advised corporations on mergers and acquisitions. It traded fixed income instruments at scale. Revenue increasingly depended on balance sheet deployment. Unlike commercial banks, it did not rely on insured deposits. It relied on wholesale funding markets. Short-term borrowing financed long-term assets. This structure increased return potential. It also increased sensitivity to funding conditions. Lehman expanded aggressively during the credit boom. It accumulated mortgage-related securities. It packaged residential mortgages into structured products. It retained significant exposure on its own balance sheet. Securitization generated fees. Proprietary positions generated trading income. Return on equity became a strategic focus. Higher leverage amplified those returns. Leverage ratios reportedly exceeded 30-to-1 before the collapse. A thin layer of equity supported a vast asset base. Small valuation shifts could materially affect capital. Risk models assumed liquid markets. Liquidity was treated as continuously available. Credit ratings supported counterparty confidence. Confidence reduced funding costs. Lower funding costs supported further expansion. The model rewarded scale. The model rewarded complexity. Mortgage-backed securities became central to earnings. Commercial real estate exposure increased as well. Balance sheet size accelerated into 2006 and 2007. Balance sheet size approached $600 billion. Reported capital appeared adequate under prevailing metrics. However, asset quality depended on housing stability. Funding stability depended on market trust. The business model integrated trading, structuring, and financing. It operated efficiently in expansionary conditions. It required stable collateral values. It required continuous access to short-term markets. It required counterparties willing to roll funding. When those conditions held, returns were strong. When those conditions shifted, fragility surfaced. Structural takeaway. The business model embedded leverage as a core operating feature. Leverage was central to Lehman's strategy. It was not incidental, it was structural. Leverage allows a firm to control more assets than its equity base. Equity acts as a buffer against loss. When leverage rises, that buffer thins. At a leverage ratio above 30-to-1, $1 of equity supported more than $30 of assets. A 3% decline in asset value could significantly impair capital. Small valuation shifts carried amplified consequences. During expansion, leverage increases return on equity. Asset gains are magnified relative to capital invested. This dynamic rewards growth. It also rewards risk concentration. Lehman expanded its asset base through borrowed funds. Repo agreements provided short-term financing. Commercial paper supplemented liquidity. Counterparties rolled funding frequently. The system functioned on continuous renewal. As long as asset values remained stable, refinancing was routine. Risk models measured volatility using recent history. Recent history reflected rising housing prices. Structured mortgage products were rated investment grade. Capital calculations relied on those ratings. Internal metrics indicated acceptable risk. Market confidence reinforced those assumptions. Low funding costs encouraged additional balance sheet expansion. Profits supported further asset accumulation. Leverage became normalized. Competitors operated with similar structures. Industry standards shifted toward higher balance sheet intensity. Regulatory oversight focused on capital ratios, not funding fragility. Liquidity assumptions were embedded in pricing models. The cost of leverage appeared manageable. When housing markets began to weaken, asset volatility increased. Higher volatility reduces the tolerance for leverage. Credit spreads widened. Mark-to-market losses began to surface. Losses reduced tangible equity. Reduced equity increases effective leverage. Effective leverage then increases vulnerability. The cycle can reverse quickly. What amplified returns in expansion amplifies losses in contraction. Leverage does not cause stress alone. It magnifies its impact. Structural takeaway. High leverage converts moderate asset declines into capital crises. Lehman's balance sheet required continuous short-term funding. The primary mechanism was the repurchase agreement market. A repo transaction is a secured loan structured as a sale and repurchase. Securities are pledged as collateral. Cash is received in exchange. The transaction is typically overnight. At maturity, the securities must be repurchased. This structure requires constant renewal. Each day, counterparties decide whether to roll exposure. If they roll, liquidity continues. If they decline, cash must be replaced immediately. This ties liquidity directly to confidence. Mortgage-backed securities were frequently pledged as collateral. During expansion, those securities carried high credit ratings. High ratings supported broad acceptance in repo markets. Haircuts on collateral remained low. A low haircut increases effective leverage. It reduces the equity required to fund positions. As housing markets weakened, collateral valuations became uncertain. Uncertainty increases lender caution. Lenders respond by widening haircuts. Higher haircuts reduce available borrowing capacity. To maintain funding levels, additional collateral must be pledged. If additional collateral is unavailable, assets must be sold. Asset sales can depress prices further. Lower prices justify even higher haircuts. The process becomes self-reinforcing. Lehman's liabilities were short-term. Its mortgage assets were long-term. This maturity mismatch embedded refinancing risk. Refinancing risk intensifies when lenders hesitate. Repo counterparties continuously assess credit exposure. Perceived deterioration can alter renewal decisions quickly. Unlike deposits, repo funding can withdraw overnight. It does not require public panic. It requires institutional doubt. In 2007 and 2008, mortgage valuations became volatile. Volatility increased scrutiny of pledged collateral. Funding terms tightened progressively. Borrowing maturities shortened. Daily rollover requirements increased. The balance sheet required uninterrupted market access. If repo markets functioned, leverage remained viable. If repo markets tightened, leverage became unstable. Dependence on short-term secured funding limited flexibility. Structural takeaway. Heavy repo dependence converts asset uncertainty into immediate liquidity vulnerability. Mortgage-related assets became central to Lehman's balance sheet. The firm expanded aggressively into residential mortgage-backed securities. It underwrote subprime loans. It securitized them into structured products. It retained portions of those structures for yield. Commercial real estate exposure increased as well. Housing prices had risen steadily for years. Rising prices reduced perceived credit risk. Default assumptions were calibrated to expansionary data. Rating agencies assigned high grades to senior tranches. Structured diversification was assumed to reduce correlation. Risk appeared distributed across the system. However, underlying exposure remained tied to housing stability. Lehman accumulated large inventories of mortgage securities. Warehousing positions bridged origination and securitization. When securitization markets slowed, inventory increased. Inventory increases balance sheet pressure. Mark-to-market accounting required periodic valuation updates. As housing activity decelerated, price discovery weakened. Bid-ask spreads widened. Model-based valuations became less reliable. Lower liquidity reduced observable pricing benchmarks. In 2007, subprime delinquencies began to rise. Loss expectations adjusted upward. Structured product values declined. Declines were initially modest. However, leverage amplified their impact. Commercial real estate markets also softened. Geographic concentration increased sensitivity. Counterparties reassessed mortgage collateral quality. Risk perception shifted gradually. Funding providers monitored exposure disclosures. The scale of mortgage inventory became visible. Valuation uncertainty increased capital volatility. Capital volatility increased effective leverage. Effective leverage increased vulnerability to further price declines. Asset sales would crystallize losses. Holding positions required stable funding. Stable funding required sustained confidence. Confidence depended on collateral quality. As housing prices stalled, confidence weakened. Mortgage exposure did not collapse overnight. It deteriorated progressively. Each incremental decline reduced flexibility. The asset side of the balance sheet became less liquid. Liquidity on the asset side is critical during stress. Structural takeaway: concentrated mortgage exposure tied balance sheet stability directly to housing prices. Lehman's mortgage assets were subject to mark-to-market accounting. Mark-to-market requires assets to be valued at current market prices. When markets are liquid, pricing is observable. When markets thin, pricing becomes uncertain. As housing stress increased, transaction volume declined. Fewer trades reduced reliable benchmarks. Valuation models replaced direct price observation. Model inputs depend on assumptions. Assumptions became more conservative as volatility rose. Lower model valuations reduced reported asset values. Reduced asset values weakened capital ratios. Capital ratios influence counterparty perception. Perception influences funding access. Small markdowns had amplified effects under high leverage. A 1% decline could materially affect equity. A 3% decline could erode a substantial portion of capital. Mortgage-backed securities became harder to price. Bid-ask spreads widened significantly. Potential buyers demanded discounts. Discounted prices established new marks. New marks required balance sheet adjustments. Adjustments reduced tangible equity. Reduced equity increased effective leverage. Increased leverage heightened investor concern. Concern widened credit spreads. Wider spreads increased refinancing cost. Higher refinancing cost reduced profitability. Reduced profitability limited internal capital generation. Analysts questioned valuation transparency. Disclosure detail became a focal point. Quarterly reports highlighted exposure scale. Comparisons to peer institutions intensified scrutiny. Rating agencies monitored capital adequacy. Downgrade risk increased sensitivity. Mark-to-market does not create losses alone, it reveals them. In stable markets, valuation adjustments are incremental. In stressed markets, adjustments can accelerate. Lehman attempted to manage optics through asset reclassification. Certain positions were designated differently within accounting frameworks. However, economic exposure remained. Economic value deterioration influenced lender behavior. Market participants trusted observable prices over internal models. When observable prices fell, confidence declined. Capital erosion became visible. Visible erosion increases funding fragility. Structural takeaway. Mark-to-market pricing transformed housing weakness into immediate capital pressure. As asset values declined, lenders reassessed collateral requirements. Collateral protects lenders against counterparty default. In repo markets, collateral quality determines borrowing capacity. When perceived risk increases, lenders demand higher margins. Higher margins require additional collateral to secure the same funding. If collateral values fall, margin calls follow. A margin call is a request for more collateral. Failure to meet a margin call can terminate funding. During 2008, counterparties increased scrutiny of mortgage assets. Haircuts widened progressively. Widening haircuts reduced effective liquidity. Each increase forced Lehman to allocate more securities to maintain funding. Allocating more securities reduced flexibility elsewhere on the balance sheet. Unencumbered assets became increasingly scarce. Scarcity limits optionality. Optionality is critical during stress. As collateral demands rose, internal liquidity buffers narrowed. Asset pools once considered liquid became restricted. Restricted assets cannot be easily mobilized. Balance sheet management became reactive. Meeting one margin call could trigger another. Price declines generated further collateral pressure. Collateral pressure intensified mark-to-market losses. Mark-to-market losses intensified capital erosion. Capital erosion increased perceived counterparty risk. Perceived risk justified further collateral tightening. The process formed a liquidity spiral. Short-term funding amplified collateral sensitivity. Daily refinancing magnified the impact of each margin adjustment. Even solvent institutions can fail if liquidity disappears. Liquidity depends on collateral confidence. Confidence depends on asset valuation stability. By mid-2008, counterparties reduced exposure limits. Some demanded additional guarantees. Others shortened funding tenors further. Tenor compression increased rollover frequency. Higher rollover frequency increased operational strain. Balance sheet size increased the magnitude of required collateral. Large inventories required large margin support. Lehman attempted to pledge alternative assets. However, market preference centered on high-quality collateral. Mortgage exposure constrained substitution. Each incremental demand narrowed the firm's survival window. Structural takeaway. Rising collateral demands converted declining asset values into immediate liquidity compression. As collateral demands intensified, liquidity pressure accelerated. Liquidity is the ability to meet obligations as they come due. Lehman's obligations were largely short-term. Its assets were long-duration and increasingly illiquid. This imbalance increased refinancing vulnerability. Each margin call reduced available cash. Reduced cash increased reliance on additional borrowing. Additional borrowing required more collateral. More collateral reduced unencumbered asset capacity. Reduced capacity limited strategic flexibility. Market participants observed declining liquidity buffers. Observation influenced perception. Perception influenced funding behavior. Funding behavior influenced liquidity. The interaction became circular. Repo lenders shortened maturities further. Shorter maturities required more frequent rollovers. Frequent rollovers increased exposure to daily sentiment shifts. Even minor rumors could alter funding access. Counterparties reassessed exposure continuously. Credit default swap spreads widened. Widening spreads signaled higher perceived risk. Higher perceived risk justified further funding caution. Caution translated into reduced liquidity availability. Asset sales became a potential source of cash. However, asset sales occurred at distressed prices. Distressed sales generated realized losses. Realized losses reduced capital. Reduced capital increased effective leverage. Higher leverage heightened counterparty concern. Concern accelerated withdrawal behavior. Liquidity outflows became self-reinforcing. Market confidence deteriorated incrementally. Each deterioration narrowed available options. Liquidity facilities required acceptable collateral. Collateral quality remained under scrutiny. Interbank trust weakened across institutions. Market funding became selective. Selective markets penalize perceived weakness. Lehman attempted to communicate stability. Stability requires credible liquidity evidence. Evidence became harder to provide. Balance sheet transparency increased scrutiny. Scrutiny intensified pressure. By September 2008, liquidity options were limited. Short-term refinancing capacity had materially declined. The firm remained asset-rich but cash-constrained. Structural takeaway. Liquidity spirals emerge when funding confidence erodes faster than assets can be converted to cash. As liquidity pressure intensified, Lehman sought external capital. Capital would expand the equity buffer. A larger buffer could restore confidence. Earlier in 2008, the firm raised capital from strategic investors. Sovereign wealth funds participated in prior injections. Those injections stabilized perception temporarily. However, asset valuations continued to weaken. Each quarter required revised disclosures. Revised disclosures revealed larger exposure than markets expected. Market skepticism increased. Equity prices declined sharply. Lower equity prices reduced capital raising capacity. Issuing new shares at depressed prices dilutes existing holders. Dilution reduces management flexibility. Potential investors demanded transparency. Transparency highlighted valuation uncertainty. Uncertainty increased negotiation complexity. Prospective partners evaluated balance sheet risk carefully. Private capital discussions intensified. Some negotiations progressed. Others collapsed under valuation disagreement. Time worked against the firm. Funding markets were tightening simultaneously. A successful capital raise requires market stability. Market stability was deteriorating. Rumors accelerated negotiation breakdowns. Counterparties monitored capital raise progress closely. Incomplete transactions signaled vulnerability. Vulnerability widened credit spreads. Wider spreads reduced investor appetite. Potential acquirers assessed integration risk. Balance sheet opacity complicated due diligence. Asset write-down expectations increased. Increased write-down expectations reduced perceived equity value. The firm explored asset sales to improve optics. Asset sales at distressed prices signaled weakness. Weakness reinforced funding caution. Regulators observed negotiations carefully. Public support was uncertain. Without a credible capital infusion, refinancing confidence eroded. Capital markets operate on trust. Trust requires clarity and stability. By September 2008, capital solutions had narrowed. The firm required immediate support. Support did not materialize. Structural takeaway. When capital raising fails under stress, liquidity confidence collapses rapidly. By September 2008, Lehman's survival depended on external intervention. Private capital options had narrowed. Liquidity markets were fragile. Systemic risk concerns were rising. U.S. authorities convened emergency meetings. The Federal Reserve and Treasury evaluated potential outcomes. A disorderly failure carried global consequences. However, public tolerance for bailouts had weakened. Earlier in 2008, Bear Stearns had received support. That precedent influenced expectations. Market participants assumed similar assistance might follow. Policymakers faced competing constraints. Moral hazard concerns shaped deliberations. Providing support could reinforce risk-taking incentives. Withholding support could trigger systemic panic. Officials encouraged private sector solutions. Potential acquirers were approached. Barclays and Bank of America evaluated transactions. Due diligence revealed significant exposure. Asset uncertainty complicated valuation. Government backstops were discussed. Legal authority to guarantee assets was limited. Negotiations intensified over a single weekend. Time pressure constrained analysis. Funding markets awaited resolution. Counterparties reduced exposure during uncertainty. Credit spreads widened further. Equity value deteriorated rapidly. Without a guarantee, buyers withdrew. No binding rescue agreement materialized. Authorities declined to provide blanket support. The assumption of rescue was tested. Markets recalibrated expectations. On September 15, 2008, Lehman Brothers filed for bankruptcy. The firm listed over $600 billion in assets. It was the largest bankruptcy in American history at that time. The filing signaled a policy shift. Government support was not automatic. Risk would not always be socialized. The decision altered global funding dynamics. Counterparties reassessed all large institutions. Interbank trust weakened sharply. Short-term funding markets froze. Confidence deteriorated across asset classes. The decision point became systemic. Structural takeaway: when policy support is uncertain, leveraged institutions cannot rely on confidence alone. Lehman's bankruptcy filing triggered immediate market reaction. Money market funds reassessed counterparty exposure. One large fund reported losses on Lehman commercial paper. That fund's net asset value fell below $1. The event challenged assumptions of stability. Investors withdrew capital from similar funds. Redemption pressure spread across short-term markets. Interbank lending rates spiked. Liquidity in commercial paper markets contracted sharply. Corporations faced difficulty rolling short-term debt. Credit default swap spreads widened across financial firms. Equity markets declined globally. Safe haven assets attracted inflows. Treasury yields fell rapidly. Volatility indices surged. Prime brokerage clients transferred assets to competitors. Hedge funds reduced exposure. Clearing relationships were reassessed. Derivative counterparties evaluated net exposures. Settlement systems experienced elevated strain. Confidence in structured products deteriorated further. Securitization activity stalled. Investment banks faced increased scrutiny. Rating agencies reviewed outlooks broadly. Margin requirements increased across markets. Collateral demand intensified for multiple institutions. Global banks reported funding stress. European institutions with U.S. exposure felt pressure. Cross-border funding channels tightened. Currency swap markets widened. Central banks coordinated liquidity responses. Emergency facilities were expanded. Short-term funding guarantees were introduced. Policy communication attempted stabilization. However, trust had already weakened. Asset fire sale fears intensified. Market depth thinned across asset classes. Liquidity premiums increased materially. Risk appetite contracted sharply. The bankruptcy demonstrated interconnected fragility. A single institutional failure altered global pricing. Funding models across Wall Street were questioned.
Balance sheet leverage became a systemic concern. Structural takeaway: the bankruptcy transformed firm-level failure into global liquidity shock. Lehman's failure altered how institutions evaluated counterparty risk. Exposure assessments intensified across the financial system. Banks reviewed balance sheet leverage ratios. They reviewed liquidity buffers. They reviewed collateral quality. Prime brokers reassessed client exposures. Money market funds reduced unsecured lending. Interbank markets became defensive. Overnight funding volumes declined. Term funding nearly disappeared. Credit spreads widened across investment banks. Insurance companies faced scrutiny over structured exposures. European banks with U.S. mortgage assets experienced stress. Cross-border funding channels tightened. Dollar funding became scarce globally. Currency swap spreads widened. Derivative counterparties recalculated net exposures. Clearinghouses increased margin requirements. Higher margins reduced available liquidity. Liquidity hoarding began. Institutions preserved cash rather than deploy it. Asset sales accelerated across markets. Fire sale dynamics pressured valuations. Lower valuations triggered additional margin calls. Margin calls amplified balance sheet stress. Confidence deteriorated beyond the housing sector. Corporate bond markets weakened. Equity volatility increased further. Securitization issuance stalled. Structured credit markets froze. Funding models built on short-term markets were questioned. Leverage ratios became a central concern. Regulators intensified oversight. Stress testing frameworks evolved in response. Central banks coordinated liquidity injections. Guarantee programs expanded. However, confidence restoration required time. Market trust cannot be legislated instantly. The shock extended beyond Lehman's direct exposures. It redefined perceived systemic risk. Institutions reconsidered funding maturity structures. Short-term wholesale funding lost its perceived safety. Risk premiums increased across asset classes. The contagion was financial and psychological. Structural takeaway: interconnected leverage and short-term funding transform single failures into systemic crises. Lehman's collapse was not caused by a single shock. It was the interaction of leverage, funding structure, and asset concentration. High leverage reduced tolerance for volatility. Short-term funding reduced tolerance for doubt. Mortgage concentration reduced tolerance for price decline. Each vulnerability was manageable in isolation. Combined, they amplified one another. Balance sheet growth outpaced resilience. Risk models relied on recent stability. Stability can obscure embedded fragility. Liquidity assumptions proved optimistic. Funding markets can close faster than assets can be sold. Collateral confidence is as important as capital ratios. Capital absorbs losses over time. Liquidity absorbs shocks immediately. When liquidity disappears, time disappears. Time is essential for orderly adjustment. Lehman remained asset-rich until the end. However, assets could not be converted without severe discount. Discounted conversion destroys capital. Destroyed capital destroys confidence. Confidence sustains wholesale funding. Wholesale funding sustains leverage. Leverage magnifies both profit and loss. Under stress, it magnifies loss. Market participants reassessed short-term funding models. Reliance on overnight markets became a central concern. Regulators revised liquidity coverage expectations. Stress testing incorporated funding shocks. Capital standards were strengthened in subsequent reforms. However, regulation cannot eliminate structural risk. It can only require buffers against it. Corporate collapse rarely begins at bankruptcy. It begins when structure and environment diverge. Housing prices were the catalyst. Leverage was the amplifier. Funding fragility was the transmission channel. Policy uncertainty accelerated resolution. The lesson is not that risk should be avoided. The lesson is that structure must align with stress tolerance. High leverage requires stable funding. Short-term funding requires unquestioned confidence. Concentrated assets require deep liquidity. When those conditions align, returns expand. When they diverge, fragility surfaces. Lehman did not collapse suddenly. It exhausted its structural margin. Corporate collapse is rarely a surprise. It is structure meeting stress. Structural takeaway. Sustainable balance sheets align leverage, liquidity, and asset quality with realistic stress assumptions.